everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. It is chock full of good stuff. I hope you guys enjoy. Thanks for tuning in. All right, let's get started with the asset class returns for the month of November. Now, giving this a quick scan, you can see that things look a lot better here for the month of November and October. We hit the lows right at the end of September. And so we had nice positive results across the board in the update. So stay tuned. We're going to be digging a little bit more into what's going on, what's creating a little bit of this positive catalyst. But as you can quickly go through here, large cap stocks, small cap stocks, both nicely up 5 and 4%. Real estate was up as well, up a little bit more, almost 7%. The big story that I'd like to point out here is the international stocks had a very nice comeback, up actually more than the domestic cousins. So the developed market up almost 11, emerging markets up a little bit over 13%. This is something that I'm closely monitoring, not making any big changes in the portfolio, which we'll get more into in the outlook, but it might be something that we make a change here very soon. So something that I'll be watching because the dollar has been starting to weaken a little bit. Anyways, going back, fixed income, we're up nicely for bonds, up 2.8%, and high yield as well, over 1.5%. So overall, pretty good month. Even the commodities were up a little bit, and we'll get into a little bit of the why and where I feel things are going for the month of December. Thanks. All right, so the big news of the month, which was mostly the catalyst to the positive returns we saw in the market, stock market and bond market, was the fact that it looks like inflation is again starting to slow down a little bit more. We saw a little bit of that happening last month, but then it looks like in October we also had a nice reduction in the inflation rate. So this is a chart here that shows a 12-month year over year over the last several years, and you can see really nicely how it's starting to roll over. So to me, this really does look like a peak is in the works. Now, you never know these things. If the Fed lets off the foot on the brake, maybe the market will get a little ahead of itself, or we might get some faster inflation again. So these things are hard to know for sure, but it definitely looks like things are peaking and we're starting to slow down in the inflation front. That's very, very good news, because what happened was once this inflation data came out, then a couple weeks later we had the Fed come out and say, well, maybe we won't be raising interest rates quite as quickly. And they never said anything about stopping the raising of interest rates, but they're starting to acknowledge that inflation seems to be subsiding. Of course, they're going to say they still have a long way to go. They don't want the market to get ahead of things too much. So they got to talk kind of tough there, but at the same time, they are acknowledging that things are getting a little bit better, and they are also acknowledging it in their policy, because they're going to raise rates, but not as quickly. So the one in December that's coming up looks like it's going to probably be maybe a little bit more like a half point, something like that, which they were anticipating, 0.75. So again, all good signs. We had the market react very nicely to this, also even early in November. Also, a breaking development that we've seen internationally is what's been going on with China. As you can see here, there's been a lot of protests that have been happening all over the country in China, which is pretty rare. I mean, think about it. These people, if they get arrested, they don't really know exactly what's going to happen to them. It's not like here in the U.S. Where there's habeas corpus. So basically they're out there protesting because of all the COVID. It's a zero COVID policy that China has. And so they've been really tough. I mean, people are stuck in their houses. And now it looks like the Chinese government is cracking down so hard that they're taking away people's cell phones. They're checking to see if they have VPNs, so that, they're trying to get away from all the Chinese internet restrictions and things like that. So what is this going to mean for the China market and for global markets? I think there is some significance, so it is something to keep an eye on. China has already had some other issues with their banking and their real estate markets, so this is just a potential instability there for China. Now, there could actually be some good things that come from this if the Chinese government actually is concerned about their control of the country, because they were talking about maybe getting rid of the leadership, so which is also unheard of. So now that that this is out there, maybe the Chinese government will bend a little bit and be a little bit more relaxed in their zero COVID policy. If that's the outcome of this, this could actually be really, really good. But there's still so much in flux here. Right now, treading with this very carefully to see how this all plays out. And of course, a market update would not be complete if we did not talk a little bit about cryptocurrencies and the collapse of FTX, this major crypto exchange run by this gentleman here, Sam Bankman-Fried. It's very unfortunate. This gentleman here is looking like he's going to be in some pretty big trouble with the way he handled his company. Basically, the gist of it is they took customer money and they lended it to part of their venture capital investment company when they were losing money. And now they've lost that, and they've lost the client's money. So basically some big time fraud going on here, because you're not allowed to do that. If this was in a more regulated environment here in the U.S., where there's auditors and there's regulation, this would have been much more difficult to pull off. But of course, that wasn't the case in this situation here. Now, of course, this raises lots of questions for crypto in general. This appears to be more of a problem with the exchange rather than necessarily something wrong or something that is epidemic of the crypto markets in general. But again, that's something that we're monitoring. And of course, the regulations that come from here are probably going to be coming fast and furious, which would probably be a good thing. If you want to hear a little bit more about this, I did a whole video on this a couple weeks ago. You can check out on the YouTube channel a little bit more of what I think the ramifications of this will be. Alright, so a big part of my investment thesis for the next several months is based on the fact that I believe inflation is peaking. Now, we've been seeing the numbers starting to roll over, and you might think, well, that might be a little bit of a coincidence. But there's more to it than just the recent past and seeing things roll over. So I wanted to bring up 2 points. There's a lot more, but to make this video somewhat concise here, we're going to just leave it to these 2 points. One is I want to bring up the Case-Shiller Home Price Index. Remember, the biggest part of core inflation comes from the price of housing and what they call owner's equivalent rent. And the price of homes is a big part of that. And you can see here that now we're starting to see a rollover in the prices of homes. This is now 3 straight months. And in fact, this is some of the biggest changes that we've seen in decades. And so I believe that this is probably just at the beginning stages because of the mortgage markets and how the rates went up so dramatically, and especially if we're seeing a slowdown in the economy, that's only going to exacerbate this a little bit more. So that's definitely going to help keep inflation in check and maybe even get it to go down a little bit. And then the second point that I would make is that the global supply strains that we've seen over the last couple of years due to COVID is starting to finally ease up. So you can see here, historically, we've been pretty loose. The global supply chains have been super efficient. This whole just-in-time inventory systems that have been adopted over the last decade or so. But then when COVID hit, we saw these huge spikes. All this inefficiency, all these waits at Long Beach with these huge tankers, lining up for miles and miles. Well, we're not seeing that anymore. In fact, we're seeing the global supply chains really starting to ease up here, and I think that's going to be a big component of what's going to help bring at least the goods prices down quite a bit, which is a big part of inflation. That doesn't address completely all the services, but it does address a big part of inflation, which is the goods. So this is another sign, and I think we can continue to see a little bit of more of this happening here in the next few months. All right, so here is the significance of inflation potentially being at a peak and starting to roll over. If that is the case, historically speaking, when we look at times when we've had high inflation and then it peaks, you can see that the 1 year, the 3 year, the 5 years, for the most part, are very healthy, positive returns. In fact, you can see here that on average, the 5-year return was something around 60%, which is very healthy. So if this happens again, we could be looking at potentially a nice opportunity to be buying, especially while there's still a lot of negative sentiment. The Fed is still out there talking tough, to maybe start to nibble in and leg in a little bit into the market now that the prices are a little bit more reasonable, now that maybe most of the interest rate hikes are already priced in. And so this could be a pretty good opportunity, especially if you got a long-term time frame of more than just, the next few months, looking out, 3-5 years. All right, one more topic I want to bring up on the outlook, and I am calling this the bond reset. Okay, so basically over the last year or so, the bond market has taken a beating that we haven't seen in multiple decades. In fact, the stock market being down and the bond market being down as much as it is, I was reading that it's been more than 60 years since that has happened to the degree that it has. And this chart, I wanted to blow it up real big, that's why my face is so small here, is you could see all these different types of bonds and where they were basically at the end of 2021, that's the blue, versus where they are today in the yields. And this was as of October, at the end of October. So you can see how the yields have dramatically increased. I mean, in some of these, they've more than doubled. And so I'm calling this a bond reset, where the bond market just wasn't very attractive over the last few years because the yields were so low, and the yields are going to stay low for a while. But now, wow, now we can buy bonds and get 5%. And potentially if we go into a recession, which I've been talking about, hopefully a mild one, the bonds are going to hold up better. In fact, maybe even go up. So in fact, if you have a little longer term bonds, it could be even greater for you in the protection against a recession. So this is one of the reasons I've been starting to move a little bit more into the bond market here recently, especially now that things look so much more attractive. All right, so the bottom line here are the Heartwood implications. What does this mean to your portfolio? So right now, because it does look like the stock market is maybe making some gains, I'm not out there actively selling anything in the stock market, and I'm not really buying either because there's still a lot of risks out there. Inflation, there's still a chance that it could still stay pretty high, and the Fed could maybe keep rates pretty high and elevated for a while. And there's still a lot of geopolitical issues out there. So again, we're going to kind of keep our cool here with the stock market. Really no change there. But in the bond market, I have much more conviction here by that slide I was just showing you, just adding more to the quality bonds. I'm reducing the inflation protected bonds, floating rate bonds, and the shorter term bonds, adding a little bit more into the duration bonds and high quality type bonds. I'm continuing to taper the commodities, adding to cash. I'm really close to maybe adding a little bit more to gold. I'm watching the dollar. That's a big tell of what's going to happen there. But still, right now, I'm at the I'm not in a point where I'm ready to make that decision. But right now, we're just adding a little bit more to cash, kind of playing it safe. Even though the end of the year could be a good time of the year, there's still too many uncertainties there to get super bullish at this point. So I hope this was helpful, guys. I hope you enjoyed the video. It is Christmas time. I hope you guys have a wonderful Christmas season with your family. Thank you again for being such great clients, for watching the videos, for sharing. Merry Christmas. Bye-bye.